Good morning, everyone, and welcome back to Morning Markets, where the team at True Potential discuss the key things over the past 24 hours that have been impacting asset markets. Today, we're going to focus in on the return of restrictive or more restrictive measures within the UK and the potential impact that that will have. So addressing that firstly, clearly the changes that were set out by the government yesterday will change how businesses operate, with the majority of businesses moving back to working from home where that is feasibly possible. Clearly, that will feed its way through into GDP and economic activity at various different levels, and there will be an impact as we go into the fourth quarter. Thinking about the magnitude of the impact and how the restrictions are playing their way through at this point in time, that's not to say that they won't change in the future. It's unlikely that we will see the magnitude of contraction that we did see in the second quarter of the year, but there will be an impact. I think that's clear. There will be then very much more sector-specific impacts as a result if we think about some of the areas that are going to be more impacted, and hence why we've heard from the government and the Chancellor over the past 24 hours that they may indeed look at some more targeted measures that would support those sectors that are going to be more impacted, in particular the hospitality sector. So that's something that we will see coming through over the next number of days. It also speaks to the sort of sentiment in market and how sentiment was impacted at the beginning of the week, where we did see the market falling 3.5% across Europe and the UK. In that regard, it's interesting to take a little bit of a step back and think about the areas that we've been focusing on as the sort of the lenses to which to look at how sentiment is impacted. And that's primarily around five things that we've been discussing for the past number of months: monetary and fiscal support, COVID-19, infection rates, and also mortality rates. Then thinking about the reopening of economies, medical advances that are coming through for the treatment of COVID, be that in terms of the vaccine evolution, but also in terms of the treatments that are there. And then the geopolitical backdrop. So if we delve in on COVID-19, clearly infection rates are increasing. What's not been evident as yet as strongly as it was in March and earlier this year is rising hospitalizations and rising mortality rates. So that's something that we will continue to focus on to try and assess the impact of rising infection rates and ultimately then the impact on the economy. If we look at markets yesterday, we saw a bit of a mixed performance in Europe, really. Some of the indices were up over the course of the day, thinking about Germany and the UK in that regard. Then on the other side, we had France, Spain slightly weaker over the course of the day. So net, the Euro Stoxx 600 was up about 40 basis points, 20 basis points in the day, 40 basis points in the UK. A slightly different picture in the US. We had a bit of a stronger performance there with the S&P up 1.1% and the Nasdaq up 1.7%. The key thing to notice there is that the more growth-orientated sectors continued to perform well yesterday, building on that trend that we saw on the previous day. Financials remained weak in the US, and I think that's just a continuation of the stories that we touched on yesterday around the regulatory backdrop for some of those entities. Also in the US, we had the situation where the House of Representatives passed the fiscal budget for the coming year. The US does have a quirk in its system that each year the budget needs to be voted through. There's a bit of horse trading around that, a bit of a standoff, typically going down to the wire, where if it's not approved, you have a government shutdown where only essential services are offered. That wasn't the case. We've moved through that, so that takes at least that off the agenda until after the election moves its way through. Also in the US, we continue to see one of the areas that has been strong as part of this recovery, namely housing, and that continued to build with house prices increasing some 11% year on year and the number of sales continuing to increase. So a couple of things supporting the housing market in the US, some potential changes in supply-demand patterns, but also where we are in terms of the employment recovery that we've discussed over the past number of months, record low interest rates supporting record low mortgage rates. In the UK yesterday, we heard from Andrew Bailey. We touched last week on the MPC minutes and the discussion around negative interest rates and how they could or could not be used. Andrew Bailey yesterday seemed to be pushing back a little bit on that, but I suppose that's typical central banker speech, set something out, reins back, and then who knows where we might be in the coming months, depending on the shape of UK recovery. Later today, we'll get PMI data, Purchasing Managers Indices across Europe and the UK, which will give us an indication of the shape of the demand trends that we're seeing there. So we'll discuss that tomorrow, but many thanks for joining us again today, and please do subscribe to the YouTube channel. Many thanks. Bye.
Subscribing to True Potential YouTube channel is quick and easy. Simply go to your YouTube app on your phone, type in True Potential and press the red subscribe option. You'll then be notified as and when new videos are released.